Welcome to Trade the Trend, a weekly video about where the stock market is heading. This video is going to focus on the S&P 500. I'm going to cover the ASX 200 as well as gold, copper and uranium in a separate video. I'll leave a link for that in the description section below. I'm also going to tell you about the latest move in the bond market and what I think that means for equity. So make sure you stick around for that. As always, this is general commentary. It doesn't take your personal situation into account. With all of that said, let's get into our first chart. So beginning with the S&P 500. So last week's quiet consolidation has really ended in a bang with a big move down over the last couple of sessions. And of course, I'm filming this on Friday afternoon in Sydney. So I don't know what's happened in the Friday session in the US. So that's yet to be seen. But look, the fact that we're down here retesting 4,400, it's probably something that shouldn't come as a great surprise, because this is something we have been speaking about over the last, say, 4 to 6 weeks. We've outlined the possibility where we could get that zigzag type correction, which is very much what the current price action is looking like. So everything's a possibility when you're looking at markets, but this possibility is one which has been something we've been able to discuss over the last few weeks. So let's just think like what happens now. Where do things go from here? So let's start by putting some Fibonacci retracements on. So this is the one which I put on the chart something like 6 weeks ago. This is where that 4,400 potential came from. It was like looking at the lower end of the Fibonacci range. So that's where we are now. And we can also put on it's worth now putting on some support. There's a band of support which comes in at around 4,300. So it just picks up some technical activity over the last year or so. And it's currently below where the market is. So I think these are key areas to keep an eye on in the look as we move forward through the next few days, maybe the next few weeks. I think these levels really need to hold in order to keep any near-term bullish scenarios in play. And the main bullish scenario that I've been discussing is that we got the zigzag decline, and then that provided the correction that we needed to the big upward advance that we had, and then from there we could potentially look at other scenarios which takes the market higher. But for those to remain on the table, I think market really needs to hold the line around these current levels. And just jumping over to the weekly chart, I think it's important to get some weekly perspective on this as well. So let me just get rid of those lines which I just drew in. And just looking at this, so this is now the 50-week and the 100-week moving averages. And as things stand, the market is still above the 50-day moving average, the 50-week moving average, and pulling back towards it. And if we look at this chart, have a close look at this, and you'll see that at other times, so we've had a situation where the market cycled from being below those moving averages to being above. Now it's pulling back. So where are other times that happened? So we can look at the low from the COVID crash. Market cycled to above the averages, pull back to the 50-day, going back to this period in December 2018, below the averages, above, market pull back. And at the time, this is a weekly chart. This is a big pullback in real time when you're sitting through it. I'm sure plenty of people would have been saying, "Oh well, look, the big decline which we had earlier in 2018 is about to revisit. We're about to have another big decline down in the lows." I'm sure there would have been that sort of negativity happening then. And go back further, go back to 2016, below the averages, above, comes back and retests. So the current price action that we have isn't out of character with other periods where the market has cycled from below to above the averages, come back and retested. Doesn't guarantee it's going to bounce and it's going to rally. Just keep things in perspective. There's a lot of fear that the market has to decline, but just so you can see, there is another possibility that could play out. So I think at this time, I think it's a case of holding our nerve. I'm not buying the dip at this point, but I'm also not panicking into cash either. It's for me, it's a case of remaining conservatively long, but also knowing where my exits are, knowing where my exits are in each my individual stocks, and sell them when they hit those exits. And I've done that this week. There have been stocks which have left my portfolio because they've hit their exit levels. I think that remains the way to play this. And what's also been interesting this week is I saw on Twitter, my Twitter feed, I saw someone overlay a chart of the 1987 crash with this current price action, and his point was, oh look, the 87 crash started exactly like this. This is lining up for another October crash. And I think the more we see people making those sort of predictions, I think that makes them even less likely to occur, because markets don't just follow roadmaps from previous periods. These little overlays that people like to put on there, they scare a lot of people, but they rarely play out. So the more of that sort of stuff we see, probably the less likely it is to happen. Doesn't say it's not going to happen, but I don't think that should be the base position anyone is working from. But we do need to think about, like, what happens if support breaks? What happens if this if the Fibonacci's break, which we just had on previously? What happens if 4,300 gives way? What happens then? Is it still a case of saying, well, look, it's a correction, or is something else happening? And I think, should that happen, then I think we do need to consider other possibilities. So one possibility which I've been considering for a while now, but I haven't brought it up because I don't think it's been necessary to bring it up. There's been too many other things which needed to happen first to bring this one into line. But I've been talking about the zigzag, the potential for this zigzag from the recent high. When you get the zig down, the zag up, and the zig back down again. It's your classic three-wave correction. Now, this also works on a larger scale as well. So one possibility, let me just jump back to the weekly chart for this. One possibility is that, this is the zigzag which we're currently talking about. What happens if we got a zigzag on a larger scale, which then potentially would go back and retest these levels from last October? And we've seen this sort of behavior before. So you look at this period from 2018, we had the down, the up, and the down. And again, 2015, the down, the up, the down. It's you can go back through these charts for decades, and you'll see this sort of price action. It's your typical zigzag correction, and it happens on various timeframes. So I've been focusing on the daily time frame, but then when you look at the weekly, I can't rule that out. I can't rule out some sort of a retest of the October low. That would probably drag into the first quarter or mid next year potentially. That's not my base case. Let me just stress that. It's not my base case, but should these supports all give way and we find that the market is back down inside this large range which it had been in for the last for around 12 months, should we find ourselves back in that range, well then my base case would likely start to swing towards, well, look, a retest of these lows. But look, it's just a case of being aware of things that could happen, not things that will happen, and that just helps you manage your portfolio. It helps you exit things when you know you should exit things, because you're avoiding the possibility of holding things as markets possibly continue to deteriorate. That's not what I'm saying is going to happen, but we've got to be aware of what could happen and then play what does happen. So let's quickly jump over to the NASDAQ. Again, we've got the zigzag we've been talking about, same as the S&P 500, nothing new there. Just quickly throw these not moving averages, these Fibonacci's on. I'm using the March low for this, because to me, when I look at this from March through to the high, that looks like a complete move on its own, and that's how you work out what part of the move you use to overlay the Fibonacci's. Doing that, the pullback is completely proportional so far. It's sitting just above the top of the Fibonacci band. So, there's nothing crazy about this at the moment. This is so far, it still does look corrective. At some point, a corrective move can come apart, but we don't know that at this point. So far, this is still corrective. And quickly looking at the, let's just quickly look at the weekly on this. When we look at the weekly on this, we can see that the Nasdaq's still quite a bit above its 50-week moving average. And as I was saying before, it's not uncommon to see markets come back and retest the 50 and the 100 week moving averages. So if that were to happen, this could still take quite a bit longer to play out time-wise while the moving averages catch up, or volatility-wise as the market comes back towards those averages. So let's just watch how this price action plays out, and as I say, just keep a cool head. Now, if you're getting some value from this, please hit that like button. Please leave a short comment. Just, hey, thanks for the video. It just tells YouTube you're watching, you're engaging, and YouTube will hopefully go and show other people. And hit that subscribe button if you haven't already done so. Now, quickly, let's just jump over to the Russell 2000, the small caps. And look, broken support. We've had this support here around 18,020. We're now broken below the support. The moving averages are rolling over. It's definitely in the near term. It's a negative structure. We're in the bottom half of the range, and the momentum's to the downside. So there's nothing positive about this, just in the near term at least. We are still within the range, and whilst we're within the range, the potential for this being a basing pattern does still exist. But whilst we are in the lower half of the range, and with those factors I just mentioned, I don't think there's any hurry whatsoever to be doing any buying. If anything, it's a case of, as I was saying, exiting stocks which are giving way, because I don't want to be holding stocks that continue to give way, and then the next thing you find in 6 months' time, the market's down at 1,300, and you're still holding stocks going, well, why didn't I exit? It's like, if stocks are breaking support, it's time to exit them. It's just, I think it's as simple as that. You've got to give them room to move, but you've got to have your exit point where you say enough is enough. And just lastly, just quickly on the 10-year bond, new high in yield for this cycle. And again, this is something which we've spoken about for quite a few weeks now. So I first spoke about the breakout back in July. We had the break, pull back, we had the return move, looked like maybe it was going to settle down, but then it rebounded off these moving averages and has continued higher. Path of least resistance remains higher in yield, above the rising moving averages. It's and this is also something which is another sign that equity volatility probably has further to play out, whilst this trend in bond yields continues to play out. So look, let's wrap that up for this week. Thank you for joining me. Hopefully that's been interesting in trying to navigate this market. I look forward to coming back and talking to you next week. Till then, bye for now.